All right, so recording is on. Today is Monday, March 4th. Today is the 12:30 p.m. section, which is being recorded on Zoom. Again, apologies for not being able to make it live today. For other sections, hopefully you'll be watching this on the recorded video. Our main goal today is to go over the last homework assignment, both the ROIC tree and the CFI. So hopefully you get a little bit more feedback going into your second homework assignment, which will be due on Wednesday. Also on Wednesday, I want to talk a couple minutes about the upcoming midterm exam. So I'm going to share my screen. All right, so for the midterm exam, it is going to be here under the assignments tab. And it's going to be listed as the midterm exam. Okay. And it will show up on Elms based on the time that you are registered for. So for example, if you're in the 11 a.m. section, the exam will show up at 11 a.m. and then it'll go away at 12:30 p.m. For this section, it'll show up at 12:30, it'll go away at 2, etc. for the other sections. You must take this exam for the class that you're registered for in Elms during that 90-minute window of your normal class time. Okay, so again, for you on Wednesday, exam opens at 12:30. You need to submit and finish no later than 2 p.m. It will be a 10-question multiple choice exam, each question worth 1 point. Each question will have 5 answers, 4 plus none of the above answers. So again, you'll have to basically choose which one you think is most correct, and it will cover the theory of the course. You won't need Bloomberg, you won't need Excel. Basically, the exam is really just covering content, and I gave a couple examples in class last week, but that's the structure of the midterm exam. Now, there'll also be another ability to take this exam, and it'll be called the alternative midterm exam. Okay, and the only people that will have access to that alternative midterm exam will be people that have a prearranged reason to take it with me, either an ADS accommodation and or a travel arrangement where they couldn't take it during the class time, and I told them that they could take the exam at a different time that day. For those of you taking the alternative exam, you will see that exam open up at essentially 8 a.m. on Wednesday morning, and it will close at midnight on Wednesday evening. The only difference is same exam, except it just doesn't have the 90-minute timer. Although when you take the exam, you have to take it based on the time that you're allowed. So for example, if you're the person that's traveling, you still have 90 minutes to take it during the time that we had talked about that day. If people have ADS accommodation, you can take it anytime that day, so long as you submit it within your accommodation time. And so again, it's tracking the start and the end time of the submission. It's the exact same exam, and the only difference between the two are it doesn't have a default timer for the class start and end time. So again, if you're not one of those people, make sure you don't take it by mistake. You shouldn't see it, but either way, you're taking the regular midterm exam. And if you're taking it with an accommodation, don't take the regular midterm by mistake, because it will only be available during class time, and then it will go away at the end of class time. So that's what we're scheduled for on Wednesday. Questions about any of that? All right, well, if no questions, let's talk about homework 6. So in homework 6, you are to basically do the ROIC tree and CFI for Meta/Facebook. That was due this morning at 10 a.m. And then Nike will be due on Wednesday. So remember, we have two things on Wednesday, both the midterm exam on Wednesday, as well as your Nike assignment due on Wednesday. In terms of the Meta assignment, go ahead and open it up on my file folder rather than in class. I'll stop the share. Start out with the Meta ROIC. All right, sharing the Zoom. All right, so your paper, again, minimum 500 words, it should have said something like this. Looking at the end of your ROIC for Meta in 2019, it was 28.4%. In 2023, it improved to 31.1%. That was a 9.8% 5-year change. So the real premise of what you're trying to do is explain that 5-year change. Why did it go up from 28.4 to 31.1? The only other interesting thing about Meta was that it actually went up dramatically in 2021 to 42.8 before falling to 21.4 and then recovering to 31.1. So it wasn't just a vertical line down. It actually kind of peaked during the pandemic, right? Now, as we explain this, the first driver is the tax rate. Okay, so the tax rate in 2019 was 25.5%. By 2023, the tax rate had fallen to 17.6%. So over 5 years, Meta is paying less taxes, and that is one of the reasons why the after-tax ROIC went up. Okay, so we'd clearly identify that. Now, we also saw a slight drop in the pre-tax ROIC from 38.1 to 37.8. So that was a negative 0.8% 5-year decline. Again, it did surge to 51% in 2021 before falling to 37.8 in 2023. But essentially, you know, it's kind of flat, but a little bit lower over a 5-year period of time for the pre-tax business. Why? Now we go to drivers number 2 and 3. Okay. The first one is the operating margin. 2019, Meta had a pretty high operating margin of almost 34%, 33.9%. Okay. In 2023, it actually improved their margin to 34.7%. That was a 2.1% improvement over the 5-year period of time. And so that definitely should have helped the pre-tax ROIC go up. It did not. Pre-tax ROIC did not go up, but nonetheless, that was an improvement that should have driven pre-tax ROIC. Again, the big issue with Meta is in 2021, the operating margin peaked at 39.6%. It fell dramatically in 2022 to 24.8. That was around the time that Mark Zuckerberg implemented a lot of belt tightening. They cut a bunch of jobs, cut back a lot of investment, focused on the core business. And so they had a big recovery between 22 and 23. But essentially, over 5 years, they net gained 2% operating margin. Where they really got challenged was in invested capital to sales. In 2019, they were spending 89 cents per dollar of invested capital to drive a dollar of sales. By 2023, they were spending almost 92 cents, 91.7 cents. That's a 3% increase. So the reason for the slight decline in pre-tax ROIC was the slight worsening in productivity. Matter of fact, the productivity kind of canceled, the worsening of productivity kind of canceled the improvements they got in their operating margin. Right? They kind of offset each other. But overall, the productivity actually bottomed out. Lowest number improved the most in 2021 when it was at 77 cents per dollar. Again, it peaked at 93.5 in 22, and then they went down to 91.7 in 2023. But nonetheless, last 2 years have been 2 of the least productive years in terms of how much investment they've spent to drive sales at Meta. Okay. Now, going to the second level drivers for operating margin, why'd they go from 33.9 to 34.7? Anything really changed? Well, their gross margin changed. Gross margins is basically an ad business, went from 90 cents in 2019 to 89 cents in 2023. That was a 1% drop in their gross margin, right? And their SG&A went from 48 to 46, right? So even though they had slightly worse gross margin, they did spend less on SG&A, 2 cents per dollar, right? But they spent slightly more in depreciation, 8.1 to 8.3, right? And if you look at the overall impact, it was really the reduction in SG&A, which was bigger than the reduction in the gross margin in terms of percentage points. So 48 to 46 is 2 points of SG&A that were saved, 1 point loss to gross margin from 90 to 89. That was the difference in the operating margin going from 33 to 33.9 to 34.7. Okay, so really it was about, for them, the improvement in the SG&A ratio as a percentage of sales. If we look at the second level balance sheet drivers, why are they spending more capital, 89 to essentially 92? Well, they had negative 2 cents of working capital in 2019. They went to almost negative 5.6 cents in 2023. That's an improvement. More negative working capital means less invested capital. Okay. PP&E went from 63 to 81, 81.5. That's really where Meta / Facebook has been spending. They've been spending on their infrastructure spending, and they're spending a lot more on it than the corresponding sales gains that they're getting right now. Intangibles went from 27.7 to 15.9. They basically are lower every year since 2019. So that suggests that if they did any acquisitions, they were pretty minor, but overall they were getting lower invested intangibles to sales ratios over the 5 years. So really, the invested capital sales ratio got worse, primarily because the PP&E to sales went up. So again, summarizing, because of the loss of productivity in PP&E to sales going from 63 to 82, that caused the overall invested capital sales to go from 89 to 92, which correspondingly offset an operating margin improvement from 34 to almost 35 due to 1 point reduction in SG&A. And that basically kind of offset each other to maintain a similar pre-tax margin of about 38% between 2019 and 2023. So really the overall improvement in the business came from lowering the tax rate from 25.5 to 18, which allowed the after-tax ROIC to surge from 28.4 to 31.1. So somewhere in there should have been your 500 words. Questions about the 500 words for Meta, the ROIC tree analysis? Again, what I think is important is you cover every item, you talk about the impact of that change in ROIC, whether it's helping or hurting directionally on the item above, right? And basically just kind of walk your way and link your way to the first level drivers and then each of the second level drivers. Make sure you're covering every driver, right? Even if you say it has very little or no impact. So that's what's going to be important when you walk through these analysis. All right, let's go over their CFI. So looking at Meta's CFI, again, remember we're going to talk about all 4 sections. So the first section we want to start with is free cash flow. And we'll start right here with this number, which is over 5 years, Meta generated 71.345 billion of positive free cash flow. Okay. And the question is, how did they do it? Well, they generated almost 188 billion of gross cash flow over the 5 years, peaking with a 49.7 billion gross cash flow in 2023. Okay. But again, it wasn't a straight line. In 2019, it started at 23.6. It peaked in 2021 at about 47 billion, fell to 32 billion in 2022, and then rebounded to almost 50 billion in 2023. Okay. So really 2022 was a tough year for Meta. Okay. Now, of the 188 billion of gross cash flow, they reinvested 114.6 billion of gross investment. And that worked out to, for some reason, reinvestment rate didn't get copied over. So hopefully you got a calculator out. And that represented a 61% investment rate over the 5-year average, leading to free cash flow of about 73 billion. Again, not a straight line. 2.7 billion of free cash flow in 2019, growing to 24 billion in 2021, falling to 6.5 billion in 22, and then rebounding back to 24 in 2023. And you can see that one of the reasons why 2022 free cash flow was lower is because capital expenditures was almost $31 billion in 2022. And that was at the time of a lower income of 32 billion versus the more recent 46 and 50 billion gross cash flows. So that caused them to have an 80% reinvestment rate in 2022, giving them the lowest free cash flow of the 5 years at 6.5 billion. Before rebounding to 24 billion. But again, averaging out to a 61% reinvestment rate over the 5 years. But again, really it was 2019 and 2022 that they made big capital expenditure years. In terms of the CapEx depreciation ratio, yeah, should copy that over there. So you probably got to get a calculator out, but they averaged 311%, which suggests, the lowest year was 249% in 2020. Meta has been pushing a lot of growth, right? And they have been investing heavily in that growth. We can see the absolute capital expenditures that they're spending, but overall, they're spending much more than depreciation on an every given year, 3 times on average. And that suggests even with a 258% in 2023, they're still expecting growth in 2024, although it is much lower than their 2022 rate of CapEx depreciation. So spending a little bit less for growth, but nonetheless, a pretty substantial amount. Non-operating cash flows. How did they go from 71 billion of free cash flow to essentially 43 billion, 42.8 billion of CFI? Well, one of the things they did over the 5 years is they increased their excess cash balance by $22.7 billion. They also purchased about 8.3 billion of non-operating assets over the 5 years, most of that coming in 2020. And they did make 3.2 billion of after-tax interest income on the cash, mainly in their excess cash balance. But nonetheless, the overall CFI fell to 42.8 billion due to those 2 investments in excess cash and non-operating assets. How did they distribute the 42.8 billion? Well, they basically increased their debt by almost $38 billion. They sold debt all 5 years. Now, trivial amount in 2020, only 400 billion. But even in the last 2 years, 12.8 billion in new debt and 10.6 billion in new debt. Meta doesn't pay a dividend. So all of the distribution was share repurchase. They basically bought back about $125 billion over the 5 years. And so again, they've been doing some very big stock repurchases, 50 billion in 2021, and then 31.5 billion in 2022, and about 27 billion in 2023. So again, about 125 billion. And so again, because they only had 71 billion of free cash flow, and they increased their cash balance, ironically, excess cash, over the 5 years, basically all of this stock buyback was driven by profits, but they needed the debt. They needed almost 38 billion extra debt to afford that level of stock buyback because they only had $71 billion worth of free cash flow. All right. So again, those are kind of some of the highlights. They didn't really do any acquisitions. You can see here, nothing really big given their size. They probably bought somebody here in 2022 of note if you wanted to look that up, but at least highlighting that in this presentation would have been useful. Any questions about the CFI, the analysis, what we just went through, what you went through? Again, start here, cover all 4 sections, explain gross cash flow, gross investment, reinvestment rate, explain CapEx to depreciation and the major acquisitions if you see them. Explain how you got from free cash flow to non-operating cash flow, and then how the cash flow was distributed if positive, or if it were negative, where it would have come from. Right? Follow that process not only for Meta, for Nike, and for your group project next week. So back to questions. Questions about any of that? No questions. All right. So I am going to share some in the chat. Nike is due on Wednesday, 10 a.m. So make sure you submit Nike Wednesday morning. That is before you are taking your midterm exam, again, which is open book. But it's an exam, so there's no collaboration. And so again, you don't need to be in class on Wednesday. You can take the exam anywhere. But again, you have to take it during your class time. You got to be connected to Elms to do it. But Nike should have been submitted before the exam started, 10 a.m. Wednesday. So good question about that. Other questions? All right. So I'm going to put up another company. This is Amazon. And you can see that Amazon's ROIC fell between 18 and 22. Somebody help me walk through the first level. So let's see if we can get a volunteer to do one more practice round on Amazon before we turn you loose to work on your Nike assignment. So here's the data for Amazon. Tell me about the 5 years. So anybody want to volunteer before I start picking on people? Sorry. Here. All right. I guess I'll start picking on people. Maria Jimenez.
Do you want me to just explain like the EOY RIC or how much?
Yeah. Just do the first level, tax rate, margin, productivity, starting with EOY ROIC.
Okay, so in 2018, it had an ROIC of 18.5%. And if we compare it to 2022 of 2.5%, we see that it went down by 86.5%. And we can see that this is mainly due to the increase in the cash tax rate, which increased by 409.8% over the 5 years. And the EOY pre-tax ROIC went down by 73.8%. Both of these had a negative effect on the ROIC, but I think the cash tax rate had a larger effect on it.
Okay.
And then do you want me to do?
I want you to go, but just please make sure you do the from twos as well. Don't just do the percentage changes, but otherwise you're doing great.
Okay. And then you want me to do the operating margin?
Mm-hmm. And invested capital.
Okay. The operating margin went from 0.053 in 2018 to 0.024 in 2022. being that it decreased by 55.3%, and then the invested capital over sales went from 0.258 in 2018 to 0.439 in 2022, which means that it increased by 70.3% over the 5 years.
Great. And which of those two had the bigger impact on the pre-tax ROIC going down? Or did they both hurt the pre-tax ROIC?
I think they both had an impact on the ROIC.
So just make sure you add that in your presentation.
Okay.
So if this were your group project next week, this is a really good start. Make sure you use the front twos. But do any of these numbers jump out at you? And just since Maria's been talking, any of these numbers like jump out at you as a big change? I know you
I
gave me
guess
18 to 22, but did you see any big trends in the intermediate part that jumped out at you?
Are you talking about like the years in between 2019 to 2021?
Like take operating margin as an example. Like it went from 5.3 to 2.4. When did it really go down? Did it kind of go down gradually? Did you,
Yeah, over
oh,
the last year. I think between 2018 and 2021 it was pretty steady, and then from 2021 to 2022 it went down by a lot.
so that's an important trend to highlight, for example. But then here's the other thing, and this is what I would expect next week if this were your group project. Since 21 to 22 looks pretty interesting, because that's really when it dropped precipitously. The obvious follow-up question would be why. So here's where we should be doing some real world context on Amazon. So ideally, for this type of analysis, it would have been helpful to almost do an EIC first, right? Because when you do the EIC, you know much more about what's going on with the company and the industry. And then when you start to see the numbers, it makes sense why they're changing. But even if we don't do an EIC, like we should probably understand like, hey, why is Amazon's margin dropping so precipitously in 2022? What was it? Like, was it inflation? Was it a strategy they did? Is it something competitive? Like, what caused it? And obviously the analysts will probably talk about that too. Same thing with the investment. Like, when did they surge the investment, right? And it looks like between 20 and 21 is when the investment started to surge in invested capital to sales. You know, why? And I'll probably guess that a lot of it had to do with Amazon Web Services, because you know, as they've been pushing to AI and all these other things, spending a huge amount of capital building their infrastructure to allow them to sell that infrastructure. And that's probably when you started to see that rise in invested capital sales. So when you see some of these big changes in the intermediate years, flag them and explain them, or at least some high level context. That's what I'm going to expect in your group projects when you do your 10-minute presentations. But otherwise, Maria did a great job. Questions? All right. So somebody kind of build on what Maria said. Second level income statement driver. Why did the operating margin go from 5.3 to 2.4? So anybody want to take that first before I call on somebody? All right. Then let's go with Mark Gersten.
Yeah, so from 2021 to 2022, there was around a 2.9 cent drop in operating margin. In gross margin, it went from 49.4 cents to 52. SG&A went from 36.7 to 41.4, so that definitely increased too. And depreciation went from 7.3 to 8.2, so that had a much smaller increase compared to SG&A.
So really, it wasn't the gross margin because that went up. It was the SG&A, the big spend in SG&A, and to some degree depreciation that drove down the operating margin, right?
Yeah.
Yeah. And then the only other thing is, I know you're focusing on 21, 22. Make sure you also do the 5-year change as well when you do this. So
Okay.
do the 5-year change, then do the 2 that is interesting. But I think in the 5 years, you're going to basically be saying similar things. So we'll give you credit for that. So how about productivity? Why are they spending more invested capital to sales? How about Rachel? Rachel Goody.
Can you hear me okay?
You hear 5 by 5.
So invested capital to sales is increasing, which is negative to pre-tax ROIC. We can see that operating working capital to sales is increasing, which is positive. So that probably isn't having the biggest impact on invested capital to sales. PP&E to sales is increasing by 85.4% from 0.26 to 0.42, 0.492 in 2022, which is probably having the most impact because they're spending more. So they're producing the same product but spending more, which is negative to their productivity. And then intangibles is decreasing, which should be a positive thing. But I would just say PP&E sales is having the biggest impact on their productivity.
Okay, so I'll give you like credit that you got the dots right in terms of what was happening, but you're pretty inconsistent in using the numbers. So just make sure that you use numbers. Like you use numbers when you're talking about PP&E sales, but when you talked about working capital and tangibles, you were just more general. So I know you were looking at the numbers, but make sure that you use the from tos and highlight the numbers when you're doing your presentation. That applies to everybody. All right, questions about the ROIC tree analysis practice we're doing here on Amazon? All right, let's jump over to their CFI. And I forgot to set this up, so give me a second. Equals, let's do total. C3 to, let's do this, G3. Copy. Copy. Paste. Mm-hmm. Okay. So somebody start with the free cash flow of Amazon and start doing the CFI. Anybody want to volunteer before I volunteer them? So how about let's go with who do we have here? Let's go with Eric Laura.
Sure. Okay, so we can see that the total free cash flow for Amazon for the 5 years is negative $108 billion. We can see that they had a gross cash flow of positive $209 billion over those 4 years. And we can see that they had large capital expenditures, which of totaling to $342 billion, which was more than their gross cash flow. And they also had a $308 billion of gross investment, which decreased their gross cash flow in the operating section. Carrying on, they had
Make sure you reference that number.
Sorry?
Fish. Reference that number.
Yeah, they had 147 average investment rate over the 5 years.
That's what you just said there, because that and that are the 147%.
Okay. So, that.
And by the way, don't forget about that one too.
Okay. So they had a high CapEx to depreciation rate over 100%, indicating that they are growing aggressively. And this is 247%. So we could see that it's moderately aggressive to highly aggressive.
Okay.
Continuing down the sheet there. So we can see in the non-operating section, they increased their total cash by 32 billion and increased operating liabilities by 17 billion, further decreasing the free cash flow figure from negative 108 billion to negative 148 billion as cash flow available to investors.
So
And
this, by the way, doing a great job. This is the first company that's had a giant negative CFI. We haven't really had that yet. Okay. So we would clearly expect to see a way to plug that hole on the other side. So how do they plug the $149 billion hole? So Eric, you're doing a great job. I'm going to turn it over to somebody else to talk about where the 148.8 billion was financed. So let me go back here to the list. So why don't we have Stephanie Daniels take us home?
So, with their 140 million cash flow available to investors, that's negative. They increased their debt by 110 million, and their after-tax interest expense was also 6 million. Sorry, I'm like a little bit out of breath. Their after-tax increase expense increased 6,000,712. So they also repurchased shares by 6,000 million and adjust their equity by negative 50,000,712. So that's where they were able to refinance this, was by increasing their debt by 110,000 million.
So you'll notice, and again, good job. They just talking about the share repurchase. They only started share repurchase in 2022, kind of first time ever for Amazon. So they historically didn't pay dividends and they didn't buy back stock. So unlike the other companies that we looked at, Starbucks, even the last one that we just did, basically they were issuing debt to help repurchase the stock. Here, it's clear that Amazon is issuing the debt not to buy back the stock, but to fund the CapEx. Okay, because as the other person pointed out, they had the very high reinvestment rate. They spent more than they made, and so basically they had to finance it, and they financed it through the debt. So that debt was financing the CapEx. So it's a different view. Amazon is really investing for their future. They're spending very heavily, and they're borrowing money to basically give them the infrastructure to continue their growth. And so again, a lot of that growth is going to probably be in Amazon Web Services. And so that's be the point. Like if we were doing this for the project next week, we should know a little bit more about Amazon and which businesses are growing and why it's funding those businesses. So just a little bit more context than just reading the numbers. Questions? But good job for the students that I put on the spot. And it was hard to do that when you're just called upon. All right. So your group project next week. So next week, you're going to do a group project. You're going to do a 10-minute presentation on that project. And basically, you're going to have to go through in the 10 minutes, both the ROIC tree and the CFI with the from-tos, using the numbers, walking through all the parts, and adding that context. If anything changed, why did it change? What happened in the real world that caused it to change? just the big trends. And so with Amazon, there'd probably be three. You know, in the ROIC tree, if we were doing this, we'd be talking a lot about what's going on here in 21 to 22, right? Or here, what happened between 20 and 22 when they started spending much more on PP&E? Why? What was the triggering mechanism for that, right? Because that would be the kind of interesting numbers for Amazon, right? And then here in the CFI, probably a similar answer, but you know, why this 147% reinvestment? Like, you know, what's causing Amazon to spend all of this capital expenditures? And what are they spending it on? Like, that's what I'm saying. It's kind of, you know, company dependent, but when you see these kind of big changes, these would be the obvious questions that should be coming up. And so you should have some contextual answers than just the math changed. And that's what I expect, because again, you got a group of like 7 or 8 people and over the next week as you're working on it to do this. So, you know, without doing an EIC, you should do some of the things from an EIC to give you the context of what's going on with the company that I'm going to give you as you're actually doing your analysis next week. So that's what's going to be different when you do this as a team. You're just going to be doing this as a PowerPoint presentation. And so make sure you have all the data in the PowerPoint that you're presenting on and use numbers as you go through it and to get it done in the 10 minutes. So again, approximately 5 minutes for each one of these analysis, 5 on the tree, 5 on the CFI. Okay. So the company that I've decided that we're going to do, just because we've been talking a lot about it this semester, is NVIDIA. Okay. So I'm going to give you the NVIDIA data. I'll give you the tree and I'll give you the CFI, kind of like what you had for the homework, right? And I'll put it up later this afternoon for all the sections. And so again, that's going to be what you're going to be doing your team presentations on next week. Okay. So similar to what we're doing here in the verbal stuff, but you'll just be doing it on NVIDIA. So that'll be your team project. All right. So before we leave for the day, questions about any of that? So somebody said, what's the company for the presentation? NVIDIA. That's the company for the presentation. All right, last but not least, quick check-in. Let's see if I'm logged into Bloomberg. Thought I was. Just check in on your Bloomberg trading challenge. See how we're doing. SG. This is section 201. So here is where we stand today. I have to say the gains have been pretty impressive considering we're in week 4 of 6. Presentation or this trading challenge ends on the 13th. All of the teams but one have made the 10 required trades. So the team that's in first place needs to buy something else with your $166,000. But they have a clear return lead as of today. And again, everybody's under the 300,000 available cash, which is good for this section. Any questions about your trading challenge? And just to see how you're doing against other sections, here is section, the 11 a.m. section, where this team, I don't know what they have done, but they have a 27% rate of return. So they're doing a really, really good job. Or at least got lucky. Here is section 301. They have a 29% rate of return in first place. And again, everybody in the class is at least double digits, which again, pretty darn impressive. And section 401, returns not as high, Although we got two teams kind of fighting neck and neck for first place in that section with almost 14%. And this team has way too much cash. So I don't know, Sea Cantor team, what you're doing, but you have been warned. Get out of cash, and you have a few hours to do it. All right. Questions about the trading challenge? All right, well, I'm gonna post this video recording very shortly. If you want to use this as a reference, make sure you finish up your Nike on Wednesday. Make sure you do the midterm exam on Wednesday. And again, start working on your group project, data available soon on NVIDIA. Thanks for being flexible today on the Zoom class, and look forward to seeing everybody in person next week. Have a good day.